Today I want to talk about this video of Andrew Tate speaking on AMC and GameStop, on how employees that work at hedge funds are typically awful people and how he's ready to squeeze the shorts. And I also want to talk about how these hedge funds and market makers are on the brink of bankruptcy. So stay tuned and let's make some money. Now, if you don't know who Andrew Tate is, he's somebody who went very viral on basically all social media platforms, on YouTube, Twitter, TikTok, Facebook and everything else under the sun, before being deplatformed for being controversial. Now, I think this video I'm about to show you is actually back from January of 2021, or maybe even back from June of 2021, but it wasn't really discussed much at the time. I think this video is still just as applicable today as it was back then, as he largely talks about Melvin Capital's bankruptcy and about how people that work at hedge funds are just awful people. Now, obviously, typically Andrew Tate is not very PG at all, so I'm going to try my best to remove all of the obscene language and make it viewer friendly like I always do. But before I dive in with the key information, be sure to drop a like down below, subscribe to the channel and ding that notification bell. If you're currently sat on the sidelines and you haven't yet started investing, Moomoo will help you get started with 15 free shares worth up to a whopping total of $30,000. If you are already investing, the Moomoo platform is likely easier to use and contains more advanced tools for free than any other platform out there.
This is the most fun I've had in years.
It's super fun.
This is one of the funniest things.
It is.
This is why though. This is why. These hedge funds, I've been around them. Most of you guys watching this haven't been around these kind of people. I've been around these kind of people when I was kickboxing world champion, or when I was buying my Bugatti, or when I was hanging out in Monaco. I've been around these people. They're the worst people on earth. They're rude to staff. They have no respect for anybody. And they have no talent. They don't make money. They just have a pot of money and they manipulate markets and make their little pot go up with other people's money, and they get bailed out by the government anyway. They're complete with no skill. The worst people in the world. And they'll wipe out all the normal traders, all the average person. They'll completely wipe them out and they'll sit there with their big pot of money and manipulate the markets. When this wakes up and his 13 billion it's gone. He hasn't got an income. He hasn't got a business. He can't make it back. 13 billion has vanished from the stock market and gone to Redditors. It's brilliant. I've got 10 or 11 million dollars. I'm not that rich. But what kind of would I be if I'd be scared to lose one of my millions? I have 11, now I have 10. If I'm not contributing towards the destruction of hedge funds. This is the thing. This is the problem with millionaires nowadays. I have 11 million. Ooh,
They put it in hedge funds.
They put it in hedge funds.
We don't have any of those in hedge funds. We're from the street. I'm not giving my money to some hedge fund. I'm not stupid. I got 11 million, right? Let me tell you something. My life would be exactly the same if I had 5 million. Yeah. So if I have to lose 6 million to destroy Wall Street, I'm ready to go. All these people on Reddit are geniuses. They're geniuses. And this GameStop thing is genius. If you actually look at it and read what they've done, it's pure genius.
It is
brilliant.
pure genius.
And what they're doing on all these other stocks, they're going to war with hedge funds.
So there we can see that Andrew Tate is clearly ready, or was clearly ready, to try and squeeze the shorts with a whopping $6 million. Now, obviously, Melvin Capital did actually wake up, and over the last year and a half, Melvin Capital has actually lost the majority of that $13 billion and is winding down the firm. Obviously, Melvin Capital hasn't yet fully closed out of their short position, or maybe they've transferred it to another hedge fund, as Melvin Capital can't wind down until it's fully closed out or fully transferred out. But it's likely that another hedge fund out there has picked up the Melvin bags and is still holding this very heavily over-leveraged short position on GameStop and AMC. And we know that these hedge funds are edging closer and closer to bankruptcy and closer to being liquidated due to massive investor withdrawals. And as Donahue George tweeted, he said pension funds are pulling out of hedge funds and Missouri is out of Blackrock. Is it because they're tired of losing money? Because the SEC refuses to do their job? This Reuters article shows that Missouri has just pulled out $500 million from Blackrock over the asset manager's ESG push. And as a quick reminder, if you haven't already, be sure to sign up to Moomoo right now using the link in the description below. You can currently get 15 free shares worth up to $2,000 each, a whopping total of up to $30,000. Now, whether this Missouri pension fund has really withdrawn the $500 million due to the ESG push, or just because they've lost hundreds of millions of dollars already over the last year and a half, it's yet to be known. But what this is showing is that another $500 million has just been withdrawn from Blackrock, and that makes them $500 million closer to a margin call. That's $500 million less capital they have to meet their capital requirements and to avoid that coming margin call. And obviously this Missourian pension fund isn't the only fund and isn't the only institution withdrawing money from Blackrock. They've lost billions, if not trillions so far in withdrawals already. We know that BlackRock lost $1.7 trillion from investments alone so far this year in the first 9 or 10 months of the year, and it wouldn't surprise me if they've lost another billion or even $2 billion in withdrawals. And he also tweeted saying that widespread redemptions are making losses mount in hedge funds as it appears the investors are losing faith in the hedges and they're taking their money out. This article posted today suggests that hedge funds recorded widespread redemptions covering nearly all strategies and size categories last month as the stock and bond markets around the globe continue to plunge. So these hedge funds right now are basically stuck between a rock and a hard place. They're obviously taking on heavy losses due to the stock market crashing, and they're taking on heavy losses from their fund due to investor withdrawals. Obviously these investors don't want to lose 20%, 30%, 50% of their money or more, and therefore they're withdrawing their money and placing it into safer investments. But that obviously leaves these hedge funds with less and less capital to meet their capital requirements and obviously brings them closer and closer to a margin call. And obviously when these hedge funds do actually end up being margin called, they'll be forced to sell off their long positions and forced to close out of those shorts. When a hedge fund is fully liquidated, they don't just liquidate the long positions and keep all the shorts, they liquidate all positions in their entirety to wind down the hedge fund. Now obviously, as I've spoken about before, maybe some of the first hedge funds that end up being liquidated will simply be able to pass their short positions on to another hedge fund in return for cash. We know as a result of these securities financing transactions that when many of these hedge funds are liquidated, they'll be trading their long positions for cash to avoid crashing the market and avoid having a fire sale on these assets. But they're also likely to try and trade their short positions for cash, not to avoid a fire sale in the markets, but to avoid a fire squeeze. But obviously, even though the first few hedge funds may be allowed to trade their short positions to avoid the market squeezing AMC, as more and more hedge funds end up being liquidated, there'll be less and less hedge funds that can possibly take on these over-leveraged short positions. Because obviously when a hedge fund or when many hedge funds take on more of this toxic short positions, it effectively brings their fund as well closer and closer to bankruptcy. And therefore, even if AMC doesn't squeeze in the first wave of liquidations, it will squeeze in the second wave and again in the third wave of liquidations as well. And I think Jan Jack has really summarised this perfectly. Charles Gasparino tweeted a while ago saying the world is falling apart because people invested money into that theatre chain and a lot of other rubbish. But obviously, as Jan Jack tweeted, he said a world is falling apart, and that's the old world in which hedge funds and synthetic share makers manipulated markets without a force to challenge them. They created billions of fake shares and FTDs, creating these very heavily over-leveraged and risky short positions, which have the same inflationary effect in the economy as the Fed's insatiable money printing habit. AMC is only a $3 billion company, but AMC alone threatens to destroy the $50 trillion financial system. The reason why that is the case is due to all of these synthetic shares and these derivatives on AMC as a whole. There's obviously billions, if not tens of billions, if not hundreds of billions of dollars worth of AMC synthetic short positions and AMC derivatives trading on AMC at any one moment. And obviously when AMC does squeeze, it will blow up these synthetic short positions and blow up these derivative positions as well. And as Gold Telegraph tweeted, they said one of the world's largest hedge funds is warning the UK pension fund crisis is just getting started. Obviously, UK pension funds almost experienced a crisis the other week, but the Bank of England temporarily delayed this crisis by re-kickstarting the money printing quantitative easing. But obviously this is just a temporary measure to delay the inevitable pension fund disaster over here in the UK. It's likely we are going to see many pension funds over in the UK being margin called and liquidated, and that's why the pension fund crisis is just getting started. And in a similar note, over in the US, mortgage demand has just dropped to a 25-year low as interest rates have just climbed to an average rate of over 7%. This is that demand for mortgages to buy a home and to refinance fell again, hitting its lowest level since 1997. Home buyers' demand for mortgages dropped 4% further this week and was 38% lower than the same week 1 year ago. And this is also at a time when new property inventories and just general inventories are at all-time highs, as the demand for actual mortgages themselves and the demand for homes is at all-time lows. And obviously looking at the supply and demand equation, with a massive flood of supply and a minimizing in demand, it will cause a price imbalance and a housing market crash. In terms of AMC today, we're also seeing the cost to borrow maximum rocketing up to 291% to borrow AMC shares, and the cost to borrow average is at 22.72%. This I think is important because it shows the cost to borrow on AMC hasn't reduced back down to 1 or 2%, it's staying strong at 22%, and there's some hedge funds out there even paying 291% interest to borrow AMC shares. That means if they're borrowing $1 billion worth of AMC shares, they have to pay $2.9 billion in interest to borrow those shares over a year time period. Obviously, when the interest rate was 1%, that makes a very marginal difference, but obviously when they're paying 3 times their short position on a yearly basis just to borrow these shares, we can very easily see how these hedge funds are running out of available margin so quickly. And finally for today, Ryan Cohen may have already been working with Carl Icahn since February. On Carl Icahn's birthday, Ryan Cohen tweeted saying, "God bless Jamaica," obviously with a pirate flag. Now, Carl Icahn was obviously a corporate raider, and a pirate is a form of raider. Now, obviously what makes this most interesting is the fact that Ryan Cohen tweeted this tweet on Carl Icahn's birthday this year. And therefore it's likely that Ryan Cohen and Carl Icahn are already working together and have been for some time now. They're obviously trying to strategize and have been trying to strategize a way to squeeze these shorts and obviously profit massively from their investments. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.